Okay, I wanted to go ahead and go through a quick example of an intercompany debt transaction, which is one of those constructive retirement problems. And I wanted to go ahead and, I know I did a couple videos of a sort of a classroom example of me lecturing at a whiteboard, but I wanted to go ahead and do sort of a complete one where we also sort of integrate it into the system of consolidation entries that the textbook uses. So here we have, and we're going to do this twice. First, we're going to do the straight line amortization because that's simpler, and then I'll do a separate video doing it as under effective interest method, which is a lot more time consuming. In any event, assume that Big owns 80% of Little Company, which was purchased several years earlier. All of Little's assets and liabilities have fair values equal to book value. At the beginning of the current year, January 1st, 22, Little's common stock and retained earnings are $50,000 and $150,000 respectively. Little reports earnings of $30,000 each year and pays $10,000 in dividends each year. On January 1st, 20, Little issued $100,000 of 10% 10-year bonds at 102, and they issued these things on the open market, and the bonds pay interest every December 31st. On 12/31/22, so after 3 years, Big bought these bonds on the open market at 103.5% of face value. First, a couple points of confusion. The 102 and the 103.5 bond prices are usually expressed as a percentage of face value. So if it's $100,000 of bonds priced at 102, that means they sold for $102,000. If there was $50,000 worth of bonds, or $50,000 face value of bonds issued at 102, that means they would have sold for 102% of $50,000 or $51,000. I just use $100,000 because it's a nice round number. Unfortunately, that sometimes leads people to mistakenly believe that since in my example 102 represented $102,000, that 102 means $102,000 in all cases and all contexts, which is not the case. Again, the price is a percentage of face value. In any event, let's assume that both firms use effective interest amortization. Now, we don't have, we do have to do this in this format. Let's go ahead and figure out how much of a gain or loss there was on retirement. So we're going to start with the book value of the bonds, and the book value is going to be the face value plus or minus any remaining discount or premium. Now, these things were initially issued at a 2% or $2,000 premium. That premium is being amortized straight line over 10 years at the rate of $200 per year. So after 3 years, $600 has been amortized, so we're left with $1,400. So it's got a book value or a carrying value of $101,400. They were bought back by the parent corporation for $103,500. So we had liabilities of $1,014. We paid $1,035 to satisfy them, and so we should expect to see a loss on retirement of $2,100. All good? Now, again, in contrast to intercompany sales of inventory and intercompany sales of non-current assets and things of that nature, in those cases, we had a gain or a loss which was on one of the company's books and was unrealized. We had to take it away. This is turned 180 degrees out. Basically, neither company is showing a gain or loss on bond retirement individually. Little, the issuer, has a bond payable liability. Big, the buyer, has a bond investment asset. And yet, from a consolidated standpoint, these bonds have been retired at a $2,000 to $100 loss. So we're going to need to put this loss on the consolidated income statement. So actually, let's go ahead and get a few more ducks in a row before we do anything further. The issuer's annual premium amortization. We just figured that out. That was a $2,000 premium spread over 10 years. That's $200 per year. The buyer's annual premium amortization. Now, the buyer bought these things for $103,500, so a $3,500 premium. These bonds, 3 years of the 10 has already elapsed, so there's 7 years left to go. So the buyer has premium amortization of $500 per year. So the issuer's interest expense, and this is going to be, this is going to be information we're going to need. The issuer's annual interest expense is going to be the coupon interest of $10,000, 10% of face value, plus or minus the $200 premium amortization. And here's where hopefully you don't flip a coin. Do you add or subtract that $200? When you have a bond premium, that reduces your borrowing costs. Basically, Little took in $102,000. They've only got to pay back $100,000. The $2,000 extra, they get to keep that, and so that serves to defray or offset part of their borrowing costs. The buyer's interest revenue, same idea. They've got the coupon interest of $10,000, but they're amortizing a $500 annual premium, so that's going to reduce their interest revenue down to $9,500 per year. Okay, let's go ahead and do our elimination entries. First we have our, well, we're going to come to a roadblock right away. First we have our basic entry. Now again, the easy parts. Common stock, we eliminate the beginning of year common stock, which was $50,000. We eliminate the beginning of year retained earnings, which was $150,000. We're going to eliminate the dividends declared, which was $10,000. Okay, and that we've sort of picked the low-hanging fruit. Now we need to figure out how much investment income do we need to eliminate here, and how much income to the non-controlling interest. Now, again, think of what we did in the example I posted just today. YouTube is still processing it. We had to take either the parent's share of the reported earnings or the non-controlling shareholders portion of the reported earnings and adjust that up or down for the effects of intercompany transactions. So for the parent, what are we going to have? We're going to have their share, 80% of the reported earnings, and the reported earnings are $30,000. And then we say, okay, what was the effect of intercompany transactions this year? Again, we are putting what was the amount of the loss? We're putting a $2,100 loss on the consolidated income statement. So basically, we're going to go ahead and take away the parent's share of that $2,100 loss. So again, this is where it's critical. Are we talking upstream or downstream? The upstream versus downstream is based upon who issued the bonds. In this case, the subsidiary, Little, was the issuer, therefore it is viewed as an upstream transaction. So we're going to go ahead and take away 80% of that $2,100 loss. So the subsidiary's realized earnings, again, they had $30,000 reported, but then there was this $2,100 loss that really should have been put on there. So the realized earnings are $27,900. So 80% of $27,900 is $22,320. Again, if this had been downstream, then instead of taking 80% of that $2,100, we would allocate 100% of the $2,100 to them. We do the same thing for the income to the non-controlling interest. Again, we're going to get their share, 20% of the reported earnings. Whoops. And then we need to adjust that to account for any unrealized or realized gains and losses. Again, I get, verbally I get tongue-tied here sometimes, because in the previous two lessons, when we had intercompany inventory transactions and intercompany fixed asset transactions, we had an unrealized gain or loss that had to be removed. Now again, we're turned 180 degrees. Now we have a realized but unreported gain or loss, which has to be interjected or inserted into the consolidated income statement. In any event, we need to go ahead and take away their share of that $2,100 loss, which was realized but not reported. So again, their share, 20% of $27,900, is $5,580. Okay, now one more thing, make it a little wider. One more thing we need to do, or need to talk about real quickly, is, again, the whole point is, from a consolidated standpoint, these bonds no longer exist. We need to remove all vestiges of them, and we need to go ahead and record the gain or loss in retirement. We're also, in addition to adjusting by recording this loss, we're also at some point going to need to eliminate the interest revenue and interest expense that the companies are reporting. Now here, this is another place where the date becomes critical. These bonds were purchased by the related party on December 31st, 2022. That means that in 2022, there was no intercompany interest expense or revenue. The interest expense that Little incurred in 2022 was paid to some external third party, and we want to leave that alone. We're not going to start eliminating the interest revenue and the interest expense until next year. So now we do the investment in Little and the non-controlling interest, and just like we did before, we say, okay, what we're going to do is we're going to allocate to the parent's investment in Little their share of the end-of-year book value, plus or minus these adjustments that were being made. So the end-of-year book value. We had our common stock plus our beginning-of-year retained earnings plus our reported earnings minus the dividends declared. So the end-of-year book value, beginning of year book value is 200, went up by 30 because of earnings, went down by 10 because of dividends, is now 220. So the parent and the non-controlling shareholders are going to split that 220, in an 80-20 ratio. In addition to that, they're also going to get these same adjustments. So the investment in Little is going to be, again, their share of the 220,000. Oops, I need to put a parenthesis in front of that. It's going to be their share of the 220,000 minus their share of that $2,100. Again, we're making the exact same adjustment that we made 5 lines above that. So 80% of 220,000. Oops, that should be 2,100, not 1,200. Um, 220 minus 2,100 is 217.9. 80% of that is 174,320. Likewise for the non-controlling interest. They're going to get their share, 20% of the $220,000, minus their share of that 2,100. So again, 220 minus 2,100 is 217.9, and the non-controlling shareholders get 20% of that, or 43,580. Okay, so again, the presence of these intercompany transactions, sort of makes a little bit of a mess of our basic elimination entry. But again, do this calculation to figure out what is the parent or the non-controlling interest's share of their earnings, plus or minus these relevant adjustments for intercompany transactions, and then you make the exact same adjustment to their share of the end-of-year book value. Okay, excess value entry is not applicable because all assets had fair values equal to book value, so I'll say not applicable. Now we need to go ahead and record the retirement of these bonds. And in this case, what I really strongly recommend is make up a little, sort of shopping list of what is on the issuer's books and what is on the buyer's books relative to this bond issue. So what does the issuer have? The issuer has bonds payable, and they've got a premium on bonds, and they've also got interest expense, but again, this year the interest expense was not intercompany interest. So I'm going to write the words there, but it's going to be not applicable because it wasn't intercompany interest. Again, what we're trying to eliminate, we're trying to say these bonds have been retired at the end of the year. Since they were retired at the end of the year, that wouldn't have any effect on the 2022 interest expense or interest revenue. So what does the issuer have at the end of the year? They've got bonds payable of $100,000. And this is where you need to be real careful. I'm going to put that in capital bold, big font, margin center. Oops, there we go, margin center. Okay, premium. Now, again, this premium of $1,400, that was the premium at the end of the year. It's still the end of the year, so now it's going to be $1,400. What does the buyer have? The buyer bought these things, and they paid $103,500. And again, next year, and we will go ahead and do next year, they will have interest revenue next year, but for the current year, it's not applicable because, again, they didn't buy the bonds until the last day of the year, so they didn't get any interest this year. Now again, from a consolidated standpoint, these bonds no longer exist. They have been retired. So what we're essentially going to do is go through and eliminate all of these accounts. And so this, once you get your little shopping list here, this becomes, almost trivially easy. What are we going to do? We're going to get rid of bonds payable. Bonds payable has a credit balance, so we're going to get rid of that with a debit. Premium on bonds. Premium on bonds has a credit balance, so we're going to get rid of that with a debit. Investment in bonds, let's leave a line here. Investment in bonds is an asset with a debit balance, so we're going to get rid of that with a credit. Now, this entry obviously does not balance. We got $101,400 on the debit side. We got $103,500 on the credit side, which is basically this stuff over here, right? So here we have the book value of the bonds, what we paid for them. What's missing is that $2,100 loss on retirement, which we are now putting on the consolidated income statement. Okay, let's go ahead and do another year's worth of this. Let me just copy some of this stuff down. Whoops, not drag, and copy. Oops. Okay, again, this was 2022. Now we're doing 2023. And again, the first thing we have to do is go ahead and figure out what here has changed. What do we need to, to adjust here? First, in our basic elimination entry, common stock is still $50,000. Retained earnings has gone up. Again, it was $150,000 at the beginning of 2022. In 2022, Little reported earnings of, what was it, $30,000. They paid dividends of $10,000, so retained earnings is now up to $170,000. Dividends declared is still $10,000. But now we've got to figure out this stuff here. Stop it. Again, what we're going to want to do is make, I should get rid of that minus sign because it's not clear yet whether it's going to be a plus or minus. What we're going to want to do is adjust the reported earnings. Let's get rid of that whole thing because that's all going to change. For the results of this year's, or the effect on this year of last year's intercompany debt retirement. Now, there's two ways we can go about doing this. First, let's go ahead and update our shopping list of what account values there are at the end of the year related to these bonds. Bonds payable still $100,000. The premium, again, the the issuer is amortizing the premium at the rate of $200 per year. So that premium last year was $1,400, now it's $1,200. The investment in bonds. Again, this was a $3,500 premium over face value. That $3,500 premium is being amortized at the rate of $500 per year. So at the end of the second year, the investment in bonds is down to $103,000. Now the interest expense and interest revenue becomes relevant because now it is intercompany interest, and again, there's interest revenue on the bond buyer's books, there's interest expense on the bond issuer's books. That stuff has to be eliminated because it was not interest revenue or expense incurred or earned in a transaction with an outside party. So if thankfully I've already computed it, interest expense over here was $9,800, interest revenue $9,500. Now, again, think about how in the example with the intercompany sale of the fixed asset, we had a gain which we took away, and then we gave it back little by little by adjusting depreciation expense. We have sort of the same idea here. We put a $2,100 loss on the income statement, and we're going to go ahead and undo that at the rate of $300 per year over the remaining 7 years of the bond's life. That $300 per year is going to show up as the discrepancy between the interest revenue and interest expense being recognized. In any event, let's go ahead and do what we need to do here. Make some room. Bonds payable, $100,000. Premium on bonds, $1,200. Investment in bonds, $103. Okay, so that part, fairly straightforward. We just pulled that number off of our little table here. Interest revenue, $9,500. We have, okay, interest revenue obviously is a credit balance, so to get rid of that, we're going to debit interest revenue. Likewise, interest expense. Interest expense is a credit balance account, so to get rid of that, interest expense is a debit balance account, so to get rid of interest expense, we have to credit it for $9,800. Now again, this entry doesn't balance. What do we need to make this thing balance? Well, on the debit side, we've got $110,700. On the credit side, we've got $112,800, a difference of $2,100. Basically, that's the loss that we're carrying forward from the previous year. Again, think back to what we did with the intercompany fixed asset transaction. In that case, we removed an unrealized gain, and then we started realizing it as the asset was used up. Now, in 2022, the initial year, we recognized that loss, but since we didn't adjust our interest expense, we didn't end up offsetting any of it. So we're carrying forward the full $2,100, and now we ask ourselves that same question we always ask ourselves: was this upstream or downstream? If this was upstream, we would debit the entire, because again, this is a missing debit here. If this was downstream, we'd say, well, the non-controlling shareholders aren't involved, and the entire $2,100 would be debited to the investment in little. Since it's upstream, we're going to take that $2,100 and split it 80-20 between the parent's investment in little and the non-controlling interest. Okay, let's go ahead and do one. As long as we're in the neighborhood, let's go ahead and do one more year. And I think it's always a good idea to beat this down a few times. So now we're in 2024. And at this point, oh shoot, I'm not done yet, sorry. 2023, we never did finish this part. And the reason I sort of put this off was because I wanted to see what was going on down here, because this tells us what sort of adjustments we're going to be making to the parents and the non-controlling shareholders' income. So basically, what did we do here? We put a $9,500 debit on the income statement. That makes income go down. We're reducing or eliminating interest revenue. And then we put a $9,800 credit on the income statement. That makes income go up. So I'm going to go ahead and write those out separately. So we have 0.8 times 30,000 minus 0.8 times 9,500 for that $9,500 debit to interest revenue, plus 0.8 times 9,800. Let's go ahead and clean that up a little bit. That's going to be the same, not obviously, that's going to be the same as 0.8 times 30,000. Now let's go ahead and combine those last two terms. Plus 98 minus 95, so that's going to be plus 0.8 times $300. So again, think of what this 0.8 times $300 represents. I mentioned that we had this $2,100 loss that we were reporting in the first year, and now we're going to show an increase of income at $300 per year for the next 7 years. So for the non-controlling shareholders, it's going to be the same drill. They're 20% of the 30,000 plus their 20% of that $300 that we're giving back. So 30,000 plus 300 is 30,300. 80% of that is 24,240. Twenty percent of that is what did I say? 29.7 times 0.2, 59.4. Oh, 5,940. Oh, that's not right. Something's amiss there. 30,000 plus 300. So 30,300 times 0.2, 6060. I knew something was wrong there. Okay. Same thing down here for the investment a little in the non-controlling interest. Again, what is the end of year book value? So we've got, where should I put this? Ending book value. So what have we got? We've got their beginning of year book value plus this year's income minus this year's dividends. So all that works out to 50 plus 170 is 220, 250, 240. And so what is the investment little going to be? It's going to be their share, 80% of that 240,000. Again, plus or minus that exact same adjustment up here. So plus 0.8 times $300. So 80% of 240,300 is 192,240. The non-controlling interest, same drill. So 20% of the $240,000 plus their share of that $300. So again, 240,300 times 0.2, 48,060, I believe. Just double check real fast, make sure that pans out. Yeah, we're good. Okay. At this point, I would say questions on this, but obviously you can't ask me any questions. Okay, let's go ahead and do one more year real fast, just as long as we're in the neighborhood. So making this even longer and more interminable than ever. Again, this is going to start getting easy now, though. Again, what do we have to do? First thing we should do is update our little menu, our little cookbook, our little roster of account values. And again, what have we got? Well, the premium is dropping by $200 per year. Started at $1,400, then it's $1,200, now it's $1,000. Since we're using straight line amortization, interest expense, same amount every year. The investment in bonds, again, that also is dropping by $500 per year. So that's down to $1,025, and interest revenue, same as it was before. Okay, so this is the same. This changes. This changes, and this is the same. Okay, investment little and non-controlling interest. Again, think of, does this balance? On the debit side, we've got that plus that plus that. On the credit side, we got that plus that. So the difference is $1,800. So this missing debit of $1,800, again, think of what that represents. We had a $2,100 realized but unrecognized loss. We carried that forward to last year. There's our $2,100 that we carried forward. And then we recognized part of it via the disparate interest revenue and interest expense. So now we're carrying forward $1,800. And again, that $1,800, since this was upstream, that gets split 80-20 between the parent and the non-controlling interest. Up here, jumping back up to our basic elimination entry, the common stock is the same as it was before. Retained earnings is now up to 190 because it's rising at a steady 20,000 per year. Dividends declared is still $10,000. So, we do the same thing as before. The parent's investment income, their share of the reported earnings. And again, the nice thing about these is once you do, at least when you're using straight line amortization, once you do that first year, you get into this recurring pattern. Again, the idea is basically we took away $2,100 by recognizing a loss, and now we're going to give back $300 per year for the next 7 years. So just like last year, 80% of 30,000 plus 80% to 300. For the non-controlling shareholders, 20% of 30,000 plus 20% of 300. So the exact same income as last year. Last year it was, and I apologize for scrolling up and down like this, but this is the exact same computation we made last year. So last year it was 24,240 and 60,60. Okay, so that part, same as it was before because A, because they have the same reported earnings every year, and B, because we're using straight line amortization. For the investment in little and the non-controlling interest, again, what do we need to do? First, we need to figure out what's the end-of-year book value. End-of-year book value is going to be their beginning-of-year common stock plus their beginning-of-year retained earnings plus their reported earnings minus their dividends this year. So 50 plus 190 is 240, up to 270, down to 260. So that's their end of year book value. And so again, we're going to split that 80-20 between the investment in little and the non-controlling interest, and then copy these same adjustments. So let's go ahead and do that. 80% of 260 plus 80% of 300. For the non-controlling shareholders, they're going to get 20% of 260 plus 20% of the 300. So 260,300 times 0.8 is 208,240. %of that same thing is 52,060. Okay, again, we get into this nice recurring pattern. Can't say it enough. The nice part about this is it was straight line amortization, so we didn't have to worry about, under effective interest, obviously every year the interest expense and interest revenue is different. The premium or discount on the bonds doesn't fall in a nice linear fashion. So it's just computationally it's messier, but it's nice to do the first example using straight lines so we can sort of get the concept down, and then we can go ahead and make it messy and do an effective interest amortization method. Okay, as always, if you have any questions, please feel free to email me or post a question on the Ask a Question link on the course webpage. Thanks a lot. Bye-bye.